From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 19th, 2025. Let's see what's happening. Well, the crew is out of town this week. First they're in St. Louis, then off to San Diego. Closer to home this weekend, the Cedarburg Wine and Harvest Festival. That's a big deal. So is the Bayview Bash, and still one more festival on Sunday. It's the 12th annual Puerto Rican Festival at the Summerfest grounds. That's good food. Okay, we get this profile from Rolling Stone magazine. It's a profile of White House Deputy Chief of Staff, the charming and delightful Stephen Miller. It's been reported Stephen likes to play with dolls. The White House had to take time out of their usual busy day to issue a denial. They would like the public to know that Stephen Miller definitely does not play with dolls. I guess that puts an end to that. And that's another 30 minutes I'm never going to get back. An Orange County woman is charged with illegally registering her dog to vote in 2021, 2022, and 2023. She took Fido into the voting booth, and the dog voted. I'm not sure how, but the votes were counted. 3 years in a row, the votes counted. I'm not sure even Lassie could do that. And finally, we recently lost one of the last great movie stars of a generation, Robert Redford. Redford once told this story about his best buddy, Paul Newman. They had a tradition of trading the same birthday present year after year after year. It started when Newman bought Redford an early 1960s beat-up junker Chevrolet, then put a big bow on it and had it delivered to Redford's ranch in Utah. The next year, on Newman's birthday, Redford sent the same car to Newman's mansion in Beverly Hills with more blotches and dents and even a bigger bow. They exchanged the same car for over 20 years, with the car getting progressively uglier and uglier every year, which Newman's Beverly Hills neighbors hated, but much to Robert Redford's great delight. On the podcast today, we have Adam Baley, Dave Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A strong week overall for stocks. NASDAQ up 2.2%. That's 478 points this week to close at 22,631. The S&P 500 up 1.2%, up 80 points, closing at 6,664. And the Dow Jones Industrial Average added 1% this week, up 481 points, closing at the bell on Friday at 46,315. For the year, the Dow now up 10.1, including dividends. The S&P up 4.2, and the NASDAQ up 17.8. A quick look at the performance for stocks this week, but I think really, Adam, interest rates were more of the focus of conversation. We had the Fed meeting, the September Fed meeting here Tuesday, Wednesday. We got an announcement from Jay Powell and the Fed more broadly about kind of the path immediately for interest rates, or at least the overnight lending rate, but also some conversation on where the Fed thinks we're headed.
Yeah, that was the main event this week. No questions about it. Every investor was waiting to hear what the Fed was going to do with interest rates. Widely expected to lower interest rates by 0.25%, which is what they did. They also kind of cleared ahead a path for a potential rate decrease in October. Not quite sure yet on one in December, but they did lower by 0.25%. Jay Powell speaking to the public and answering questions. They tried to explain kind of their rationale for lowering interest rates, and they see weakening in the labor market as the clear driver between their lowering rates, and also persistent inflation as a risk out there, but not a reason to keep rates where they are. Jay Powell gave an interesting testimony about their dual mandate, where it's currently in tension, where if they lower interest rates to help out the labor market, which is what they've done, they also run the risk of exacerbating the problem with inflation. And what he said is that when their dual mandate is in tension like this, and there's risk to either side, there's no risk-free path ahead, so they can just fight the battle in front of them, and they need to address the clear problem in front, which is the weakening labor market. And that pretty much came out in his testimony this week.
Yeah, Dave, we got comments from pretty noted researcher Ed Yardeni in the Financial Times, more of an op-ed talking about, I think, some of the challenges that the Fed has in their dual mandate. I think clearly we have called into question over the past few years some of what the Fed is trying to accomplish and maybe the appropriateness of some of that going forward. Any big takeaways you saw from some of Yardeni's comments, but also just from the Fed more broadly?
Well, referring to Yardeni, it's, we've often had the conversation about where the justification and the rationale actually came from for picking a hard 2% target from the Federal Reserve. You look at the 50-year average at 3.7. We were in constant distress coming out of the financial crisis with inflation below 2 and 1.8, 1.9, where we were very fearful of deflation. And the Fed was focusing all their efforts on raising that number. So I find it interesting that we pick a hard number like 2, which appears to be pretty low. And let's face it, we can't dial it into a specific number. So I think it would have been more appropriate to have a range, from a mandate perspective, to say, hey, let's look for something between 2 and 3%, give themselves a little bit of wiggle room. So it'll be interesting to see if they end up changing that at some point here in the future. It does appear to, per Adam's comments here, that they may be looking at sacrificing the inflation mandate for trying to stabilize the labor market.
And it's interesting, going back now a decade, it feels like. We sat in on a conversation from Richard Evans, the president of the Chicago Fed at the time, who was very clear in discussing that 2% target as what they said at the time was a symmetrical risk target. And what he really meant was that, well, we've run, and again, we're going back to the mid-2010s now, we've run so far below 2% for so long that running a little bit above 2% for a while wouldn't be the end of the world. I think we've gotten that average, at least that near-term average, back above 2 now. And so I'm not sure that we can say even on a symmetrical basis we've hit that 2% inflation target. Certainly now we're beyond it. But even after, and again, you got to go back to the early 2010s to get that 2% target, even after that target, the Fed was always clear that it isn't as strict as just saying, well, we're going to try to maintain 2. It was, we're going to try to be around that 2% range. And so I think you hit it spot on. It's interesting how much we have migrated away from that conversation of 2% more or less to, well, no, it has to be 2. When the reality is, I think the economy should dictate far more what we're willing to accept. And that was part of Yardeni's point is, if you have a 3% growth on the economy broadly, maybe you're willing to accept a little more inflation than you're willing to accept if the economy's only growing at 1. Adam, the big conversation around the Fed was in part with respect to what might happen in the mortgage market and that we might see rate cuts for borrowers as a result of the Federal Reserve cutting rates. Interestingly, the 10-year Treasury actually moved a little bit higher this week, and at least in the immediate aftermath of the rate cut, we saw mortgage rates pop a little bit as well.
Yeah, and you might think that's counterintuitive, where the Federal Reserve says, we're going to lower the overnight lending rate, and yet mortgage rates went up a little bit. That does seem counterintuitive, I understand. For one, the Federal Reserve can only control the overnight lending rate, and that's literally the rate between banks that they lend overnight so that they can open up in the morning. They do not control, the Fed does not control the 10-year Treasury. But go back to the comments that Chairman Powell had made where they're going to address the labor market issues and the weakness in the labor market, and they will sacrifice for now the inflation issue and percolating inflation. And not treasuries, but mortgages are more tied to inflation than anything else. So you would think in that scenario where the 10-year Treasury and mortgage rates would tick up a little bit.
We are 40 days out today from the next Fed meeting. It feels like for every one of these meetings now, it's going to be counting down to Christmas. And I think important to note that at least when we look at futures markets, we are very much pricing in expectations for another quarter-point cut coming here at the next meeting, one more quarter-point cut before the end of the year. And then the market at least seems to think that that pace might slow down a little bit again. And so I am kind of interested to see how the economic data evolves. Joel will have some conversations on that here in a minute. But certainly I think the Federal Reserve now has signaled, yeah, we are willing to acquiesce. We're willing to pay a little more attention to the labor data, which has clearly showed some signs of weakening. and allow that to guide us a little more maybe than inflation.
Just one final point on that, Kyle. One thing I think that's giving the Fed a little latitude on that inflation battle is the fact that wage growth has settled in to a pretty reasonable number. It's right at or just slightly above the 50-year average. We're looking at a 3.9% rate in August. So that's a reasonable number. It's not putting a lot of upward pressure on any type of a wage price spiral conversation, but it's a good number. And so that they know that at least consumers are keeping up with that inflation number right now. So maybe they view this as a time where, hey, we got a little bit of wiggle room here. Maybe it is time to maybe juice the economy a little bit.
And I hope that for the labor market's sake that we can get a little boost from this, perhaps some deal making we've seen this week that may create some clarity on trade policy. You had Trump in the UK and with the conversation with Xi Jinping from China this week. I think some signs that maybe we are reaching some tentative agreements that might be the framework for a much broader agreement on trade policy. And Adam, I know one of the things that we pay so much attention to, the consumer, has been impacted pretty drastically by a meaningful change to trade as a result of some of these tariff conversations.
Yeah, and it's on regular purchases that consumers, even yours truly, makes on a regular basis, small purchases that you do online. Joel, I'm going to steal a little bit of your thunder on retail sales.
Go ahead. Be my guest.
Retail sales was decent enough this past month, but it was led by a gain in online purchases. And that was really the bright shining star in retail sales. If you take that number out, it would have looked very different. But one of the changes that we are seeing now is a removal of a rule called de minimis. And de minimis, by the way, it's a Latin term for just like, it means the little things, essentially, the things that you would otherwise look over. But de minimis applies to small purchases that are made mostly online and shipped here to the United States, and anything less than $800 doesn't really have to go through customs or pay taxes and tariffs and that sort of stuff. So small little items. And there's some history on this one. It goes back to the 1930s and, well, that trade war back then. To alleviate the pain of that trade war, we had a de minimis rule on small purchases that they didn't have to go through customs or adhere to tariffs. It started as $1 back in the 1930s. From there, it actually rose to $5 in 1990. And then $293, and then $800, I think, more than a decade ago. And now eliminating that de minimis rule, it means all those small purchases are going to be subject to customs inspections and tariffs down the road. For what it's worth, 92% of all freight that arrives here in the United States is subject to the de minimis distinction. And that's according to the U.S. Customs and Border Protection. So 92% of all freight that arrives here is subject to that de minimis.
You know, and Adam, perhaps some of that online buying that we saw in the retail numbers this week, you know, from last month, maybe some of that were people anticipating that the prices on those small orders are going to be going up.
Yours truly was part of that.
Okay.
You know, anecdotally, I have read no shortage of stories from importers, from people as simple as clothers that are trying to import fabric swatches and being charged by the shipper, DHL, UPS, FedEx, that tariff, that cost. But not only are they being charged that import cost, the tariff, they're also being charged all the fees that come with that shipper processing those. And so it may end up being not only some extra income for the U.S. government in the form of that tax now that you as the consumer are paying on those small imported goods, it may also be a source of revenue for some of the shippers as they try to figure out how to navigate all the pain that is ensuring that those duties, that those tariffs are paid.
I think as consumers, we just need to expect some delays here and confusion as we try to work through all of this. For what it's worth, you know, that 92% of shipments that are subject to de minimis, that represents 4 to 5 million parcels per day. So there is going to be some delays as we find a way and a path forward to address all this.
Joel, Adam mentioned the retail sales numbers, and I'm obviously a decent month in August coming off of July. He pointed out some of the specifics there, but what else from the economic data this week really stands out?
So that's a big one, and we always mention that consumers drive 2/3 of the economy, economic growth.
It always depends, Joel, on who you ask here, whether it's 2/3 or 70%, but it's somewhere between 2/3 and 70%.
Rounded up to 70%, and retail sales represent about 2/3 of consumer spending. So that's a good indicator. And it was up more than analysts had expected. And it's interesting, if you factor out inflation, it only went up 0.2%, but with inflation it went up 0.6%. So you can actually see where the increases in prices are adding to some of those economic figures we're looking at. Another thing that we saw this week, we're talking about signs of inflation ahead, and that that it's looking that the Fed has some wiggle room there. And one of the signs that we had for that was the capacity utilization of the industries in the U.S., and they've been below their long-term average since November of 2022. So that's a sign, at least from that quarter, that there isn't an imminent pressure to raise prices. We also had numbers on housing starts and building permits, something that stood out there. I mean, you look at building permits as the demand for building houses in the future, and that reached its lowest number since May of 2020. So right in the midst of the beginning of the COVID pandemic, that's where we got in August. Another figure that I look at within those housing start numbers is the number of houses that are under construction right now, and that actually reached an all-time peak in October of 2022. That's impressive, but it's also illustrating how far behind we got after the financial collapse in 2008. So we really had ramped up in the building of houses, and we've been going down ever since that point in 2022. We're still above where we were before the COVID pandemic, so it's still pretty high, but the trend is downward there. And as we talk about the influence of mortgage prices, mortgage rates, and what that does for the home buying demand, we're still pretty far below where we should be with the number of houses available out there.
And one of the issues that the housing market continues to face has been a lack of supply to meet demand, and that's one of the reasons why prices have gone up so much and make it difficult to afford. And you see the housing starts down 11% from this time last year. Building permits on new future houses down 11% from this time last year. That is certainly not helping supply to help alleviate some of the price pressures that we've seen.
And Adam, I think one of the things that obviously has been contributing to that lack of supply is the fact that there are so many Americans that are holding mortgages that begin with a 2 or a 3. And that was, I think, one of the bigger failures that the Fed has to take responsibility for over the last decade or so. And one of those unintended consequences of the zero interest rate policy that we embraced for so many years, I'm not sure they looked far enough ahead to think, if we're here for 10 or 15 years, what's that going to do to mortgage rates? And then let's look one step further and say, what's going to happen when rates normalize? And we're going to paralyze the housing market. And I think that's playing a big role in this situation where we have people are not able or even willing to cash in a 2.5% mortgage to take on a 7%er.
No, I think that's a pretty critical piece of what we see in the housing market right now. Certainly, as mortgage rates have fallen a little bit in the lead up to this Fed meeting, we started to see an increase in refinancing again, as I think a lot of mortgage lenders had told their borrowers, well, yeah, okay, go ahead and take out that loan at 7.25%, and don't worry, eventually rates will come back down and you'll be able to much more easily afford those payments. I think the reality, though, is that the days of 2 or 3% mortgage rates are probably long gone. I certainly hope they're long gone. Operating in an environment in which we have at least a little more skin in the game at 4 or 5% seems a little healthier for kind of where the economy is at this point. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.